Well, in a year when giants fell and almost everyone in money management seemed to take a hit, our next guest has managed to not only survive, but to thrive. We're joined by the president and founder of Yacktman Asset Management, Donald Yackman. His $739 million Yacktman fund grew more than 24% from January to June, and the fund was #1 when Bloomberg's annual rankings of mutual funds came out yesterday. So congratulations, Don.
Well, thanks.
Okay, so a decade ago, and this is why I call you a comeback story, because a decade ago things were quite different for you. Your fund had plunged, I think, like 16% during the dot-com boom, but you've since come back. Your fund is up over 20%, and you accomplished this by putting assets in cash or holding a lot of cash and avoiding financial stocks. So is this strategy going to still work for the rest of the year and into 2010?
Well, it's kind of interesting because, we're bottom-up investors, and we look at everything on a forward rate of return like a bond buyer would, and then look at the quality. And what happened is about a year and a half ago, we had some cash, but we also had a lot of, what I would consider high-quality defensive type names, or that's how they're viewed: Coke, Pepsi, Procter & Gamble, those kind of things. And then the spreads opened up dramatically around the end of last year or the first of this year with companies that had what I would say are lesser quality, and their returns just went off the charts. And so some of them are pretty good companies, but like News Corp or Viacom or some of the retailers, Abercrombie and Williams-Sonoma and Liberty Media, which is QVC. Yeah. Well, now things have shifted back almost to where they were, where now it looks to me like the spreads of going lower quality are not there, and so we're back buying Coke, Pepsi, Procter, Pfizer, that kind of thing. So
you're sticking back to that strategy that worked for you, but are you at all thinking about going into financials, which you've called black boxes?
Well, we have. It's another interesting tidbit is a lot of the S&P, people look at the S&P, but a lot of that has been permanently removed. I mean, you talked about AIG earlier on the show, and AIG is now no longer, it's 80% owned by the government. And, there's the TARP money has dramatically changed Citicorp and Bank America and so on. And then Freddie and Fannie have virtually disappeared. So the index has almost been permanently damaged by what's happened. But we have participated, but mainly in Americredit, which has been an extremely good investment for us because it's different. It's sort of like the Sesame Street game. Which one's not like the others?
And how is it different exactly?
Well, Americredit is basically they loan money to subprime borrowers buying used cars, and most people think, well, that's got to be a disaster. It really isn't. Their problem has been being able to sell off these packaged loans, and they've had to pay up for that or have had to cut back dramatically. But the reality is they have a hard book of 15, and the stock, which was down in low single digits, is back up above book now. Okay.
Don, we've only got a few more seconds, but I want to ask you, given what you've gone through in the last decade, your biggest lessons learned from that moment?
Patience. Patience, think long-term, and have a strategy that has repeatability to it.
Okay, Don Yackman, great to have you with us, and again, congratulations for having the best fund out there. Don Yackman of Yacktman Asset Management.